Question 1. Risk assessment procedures indicate that a large NYSE member firm, Global Securities Inc., has a complex organizational structure with distinct trading, research, and investment banking departments. The firm has a written information barrier policy in place, but there has been no formal review or update of this policy in over 3 years, and employee training on the policy is conducted only upon initial hiring. The compliance department has not implemented any specific surveillance systems to monitor for potential breaches of information barriers, relying instead on general employee conduct policies. Given these observations, which of the following actions by the compliance department would best address the identified risks and ensure adherence to NYSE Information Memo 91-22 regarding information barrier policies? Option A. Immediately initiate a comprehensive review and update of the firm's written information barrier policies and procedures. Develop and implement a schedule for regular, documented employee training on these policies for all relevant personnel, and establish and test surveillance systems designed to detect potential breaches of information barriers. Option B. Conduct a one-time, ad hoc training session for all employees on the importance of information barriers, without updating the written policy or implementing any new surveillance mechanisms. Option C. Delegate the primary responsibility for monitoring and enforcing information barrier compliance to the heads of the individual trading, research, and investment banking departments, with minimal oversight from the Central Compliance Department. Option D. Continue to rely on the existing written information barrier policy and general employee conduct policies, assuming that the absence of reported violations indicates the effectiveness of current controls. Correct answer is A. Immediately initiate a comprehensive review and update of the firm's written information barrier policies and procedures. Develop and implement a schedule for regular, documented employee training on these policies for all relevant personnel, and establish and test surveillance systems designed to detect potential breaches of information barriers. Explanation. Scenario analysis. This scenario presents a common challenge for compliance officers in a large financial institution, particularly concerning the maintenance of information barriers. The core difficulty lies in balancing the need for efficient business operations with the stringent regulatory requirements designed to prevent the misuse of material non-public information, MNPI. The potential for a conflict of interest, where information gained in one department could be used to benefit another, necessitates robust policies and vigilant oversight. Failure to adequately address this can lead to regulatory sanctions, reputational damage, and loss of client trust. Correct approach analysis. The best professional practice involves a proactive and comprehensive approach to information barrier maintenance. This includes regularly reviewing and updating the firm's written policies and procedures to ensure they align with current NYSE Information Memo 91-22 and other relevant regulations. It also requires conducting periodic, documented training for all relevant personnel on the importance of these barriers and the specific protocols to follow. Furthermore, implementing and testing surveillance systems designed to detect potential breaches of information barriers is crucial. This multifaceted approach ensures that the firm not only has policies in place, but also actively enforces them and educates its employees, thereby minimizing the risk of MNPI misuse. Incorrect approaches analysis. One incorrect approach involves relying solely on the existence of a written policy without actively verifying its effectiveness or ensuring employee comprehension. This approach fails to meet the spirit and intent of the regulations, which mandate not just the existence of policies, but also their practical implementation and enforcement. The absence of regular training and testing leaves significant gaps in the firm's defenses against information barrier breaches. Another incorrect approach is to assume that the absence of reported violations automatically signifies effective information barrier controls. This passive stance ignores the possibility that violations may be occurring, but are not being detected or reported. Effective compliance requires active monitoring and surveillance, not just a reactive posture based on reported incidents. A third incorrect approach is to delegate the primary responsibility for information barrier oversight to individual business units without adequate central compliance oversight and independent testing. While business units have a role, ultimate responsibility for ensuring the integrity of information barriers rests with the compliance function, which must have the authority and resources to independently assess and enforce these critical controls. Professional reasoning. Professionals facing such situations should adopt a risk-based approach. This involves identifying potential MNPI flows, assessing the vulnerabilities of existing information barriers, and implementing controls commensurate with the identified risks. Regular policy reviews, comprehensive and recurring employee training, and robust surveillance and testing mechanisms are essential components of an effective information barrier program. The compliance officer must act as an independent guardian of these controls, ensuring that business needs do not override regulatory obligations. Question 2. The control framework reveals that a financial advisory firm based in Ontario, Canada, is advising on the issuance of municipal securities that will be offered to investors in the United States. As the compliance officer for this Ontario-based firm, what is the most appropriate course of action to ensure adherence to the Municipal Securities Rulemaking Board (MSRB) regulations? Option A. Conclude that MSRB rules do not apply to the firm as it is domiciled and regulated in Ontario, Canada. Option B. Proactively contact the MSRB and relevant Ontario securities regulators to seek clarification on the applicability and interpretation of MSRB rules to the firm's cross-border municipal advisory activities. Option C. Delegate the entire responsibility for understanding and complying with MSRB rules to the firm's external legal counsel without further compliance oversight. Option D. Rely solely on the firm's existing internal compliance policies and procedures, assuming they adequately cover all potential regulatory requirements. The correct answer is B. Proactively contact the MSRB and relevant Ontario securities regulators to seek clarification on the applicability and interpretation of MSRB rules to the firm's cross-border municipal advisory activities. Explanation. The control framework reveals a scenario where a compliance officer in Ontario, Canada, must navigate the complexities of municipal securities underwriting by a firm that is also involved in other financial services. The challenge lies in ensuring that the firm's municipal advisory activities strictly adhere to the Municipal Securities Rulemaking Board (MSRB) rules, even though the firm operates under Canadian provincial securities regulations. This requires a nuanced understanding of how MSRB rules apply to Canadian entities engaging in municipal securities activities, particularly concerning disclosure, conflicts of interest, and fair dealing, while respecting the primacy of Ontario's regulatory oversight. The best approach involves proactively seeking clarification from the MSRB and potentially Canadian securities regulators regarding the applicability and interpretation of specific MSRB rules to the firm's Ontario-based municipal advisory business. This demonstrates a commitment to compliance by engaging directly with the rulemaking body and relevant provincial authorities to establish a clear understanding of obligations. This proactive engagement ensures that the firm's practices are not only compliant with Ontario law, but also align with the spirit and letter of MSRB rules where they are applicable, thereby mitigating risks of regulatory breaches and upholding ethical standards of fair dealing and transparency in municipal finance. An approach that assumes MSRB rules are entirely inapplicable because the firm is based in Ontario is professionally unacceptable. This ignores the potential for MSRB rules to govern activities involving U.S. municipal securities, regardless of the issuer's or advisor's domicile, if the transaction touches U.S. markets or involves U.S. municipal entities. Such an assumption could lead to significant regulatory violations and reputational damage. Another professionally unacceptable approach is to solely rely on the firm's internal policies without verifying their alignment with MSRB requirements. While internal policies are crucial, they must be informed by and consistent with external regulatory mandates. Without external validation, internal policies may inadvertently fall short of MSRB standards, particularly concerning disclosure obligations and conflict of interest management specific to municipal securities. Finally, an approach that delegates the entire responsibility of MSRB compliance to the firm's legal department without active oversight from the compliance officer is also flawed. While legal counsel's input is vital, the compliance officer has a direct responsibility to ensure that the firm's operations meet all applicable regulatory standards, including those set by the MSRB. This requires the compliance officer to be actively involved in understanding and implementing these rules, not merely relying on others to interpret them. Professionals should employ a decision-making framework that prioritizes understanding the scope of applicable regulations, even across jurisdictions, when engaging in cross-border or specialized financial activities. This involves diligent research, proactive consultation with regulatory bodies and legal experts, and continuous monitoring to ensure adherence to all relevant rules and ethical principles. Question 3. The monitoring system demonstrates a cross-transaction executed by a member firm on the New York Stock Exchange. The trade was executed at the midpoint of the prevailing bid and offer, and the system has flagged it as a cross between two accounts under common management. However, a review of the consolidated tape reveals that at the time of the cross, there were public orders on the book at the bid price that were executable, based on NYSE Rule 72D and supplemental material. 10. Which of the following actions by the compliance officer is most appropriate? Option A. Immediately clear the trade as compliant due to its internal nature and the speed of execution, prioritizing operational efficiency over a detailed review of potential priority violations. Option B. Investigate further to determine if the cross-transaction improperly bypassed any executable public orders on the consolidated tape, thereby violating the priority requirements of NYSE Rule 72D. Option C. Accept the system's classification of the transaction as a cross between accounts under common management and consider the matter resolved, as it meets the definition in supplemental material. 10. Option D. Focus on the execution price of the cross, noting that it was at the midpoint of the bid and offer, and conclude that the transaction is compliant because it was reasonably priced. The correct answer is B. Investigate further to determine if the cross-transaction improperly bypassed any executable public orders on the consolidated tape, thereby violating the priority requirements of NYSE Rule 72D. Explanation. This scenario presents a professional challenge because it requires a compliance officer to interpret and apply NYSE Rule 72D and supplemental material. 10. In a real-time trading environment, where the priority of orders can significantly impact market fairness and participant confidence. The core difficulty lies in distinguishing between a legitimate cross-transaction and one that might be designed to circumvent priority rules, thereby potentially disadvantaging other market participants. Careful judgment is required to ensure that the firm's trading practices align with the principles of fair and orderly markets as mandated by the NYSE. The best professional approach involves meticulously reviewing the details of the cross-transaction against the definition provided in supplemental material. 10. And the priority rules outlined in NYSE Rule 72D. This means confirming that the transaction was indeed a cross between two accounts under common control or management, and that it was executed in a manner that respects the established priority of existing orders in the consolidated tape. Specifically, the compliance officer must verify that the cross was not used to step ahead of any public orders that were entered prior to the cross and were executable at the same or a superior price. This adherence to the letter and spirit of the rule ensures that the firm is not engaging in manipulative practices and is upholding the integrity of the market. An incorrect approach would be to assume that any transaction identified as a cross by the trading system automatically complies with NYSE Rule 72D. This is a failure because the definition in supplemental material 10 is specific, and the rule itself mandates priority. Simply accepting the system's designation without independent verification overlooks the potential for abuse. Another incorrect approach is to focus solely on the execution price of the cross, assuming that if it's within the bid-ask spread, it's compliant. While price is a factor in market fairness, it does not negate the priority rules. Cross executed at a favorable price but which bypasses existing, executable public orders would still violate Rule 72D. Finally, an approach that prioritizes the speed of execution or the efficiency of internalizing trades over regulatory compliance is fundamentally flawed. The obligation to adhere to NYSE rules, particularly those concerning order priority, supersedes operational expediency. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulations. When faced with a potentially ambiguous trade, the process should involve 1. Identifying the specific rule and its definitions. 2. Gathering all relevant factual information about the trade. 3. Comparing the facts against the regulatory requirements. 4. Consulting with experienced colleagues or legal counsel if uncertainty persists. And 5. Documenting the decision-making process and the rationale for the conclusion. This systematic approach ensures that compliance decisions are well-reasoned, defensible, and aligned with regulatory expectations. Question 4. System analysis indicates that your firm's primary system for reporting trades to trace, as mandated by FINRA Rule 6700 Series, has experienced an unexpected and prolonged outage in New York. Several trades executed prior to the outage are now past their reporting deadlines. What is the most appropriate immediate course of action for a compliance officer? Option A. Inform only the trading desk of the system outage and advise them to hold all reports until the system is operational again. Option B. Wait for the primary reporting system to be fully restored before attempting to report any outstanding trades, assuming the delay will be minimal. Option C. Manually attempt to reconstruct and report the trades directly to trace without consulting internal procedures or informing compliance to avoid further delays. Option D. Immediately escalate the system outage and its impact on trade reporting to the firm's designated trace reporting personnel and compliance department, and initiate the firm's documented contingency procedures for system failures affecting trade reporting. The correct answer is D. Immediately escalate the system outage and its impact on trade reporting to the firm's designated trace reporting personnel and compliance department, and initiate the firm's documented contingency procedures for system failures affecting trade reporting. Explanation. Scenario analysis. This scenario presents a common challenge for compliance officers, balancing the need for accurate and timely trade reporting with the operational realities of a firm. The pressure to meet reporting deadlines while ensuring data integrity, especially when dealing with a system outage, requires careful judgment and adherence to regulatory requirements. Missteps can lead to regulatory scrutiny, fines, and reputational damage. Correct approach analysis. The best professional practice involves immediately escalating the issue to the designated trace reporting personnel and the firm's compliance department, while simultaneously initiating the firm's documented procedures for system outages impacting trade reporting. This approach ensures that the issue is addressed by those with the authority and expertise to implement the firm's contingency plans, which would include manual reporting procedures or other approved methods to comply with FINRA Rule 6700 Series requirements for reporting trades to trace within the mandated timeframe, even during a system failure. This proactive and structured response prioritizes regulatory compliance and data integrity. Incorrect approach is analysis. One incorrect approach is to delay reporting until the system is fully restored without any interim measures. This fails to acknowledge the firm's obligation under FINRA Rule 6700 Series to report trades promptly, regardless of system availability. The rule does not provide an exemption for system outages. Rather, firms are expected to have contingency plans. This delay could result in late reporting penalties. Another incorrect approach is to attempt to manually reconstruct and report trades without consulting the firm's established procedures or informing relevant internal departments. This bypasses internal controls and may lead to inaccurate reporting or failure to follow the firm's approved methods for handling such situations, potentially violating internal policies and FINRA rules regarding the accuracy and completeness of trade reporting. A third incorrect approach is to inform only the trading desk about the system issue without escalating to compliance or trace reporting personnel. While communication with the trading desk is important, this limited notification fails to trigger the necessary firm-wide response to ensure regulatory obligations are met. Compliance and trace reporting teams need to be aware to implement appropriate remediation and reporting strategies. Professional reasoning. Professionals facing such a situation should first consult their firm's written supervisory procedures, WSP, regarding system outages and trade reporting. The immediate escalation to the appropriate internal team's compliance, trace reporting, is paramount. This ensures that the firm's established contingency plans are activated, which are designed to maintain regulatory compliance. Documenting all actions taken, communication, and the timeline of events is also critical for demonstrating due diligence to regulators. Question 5. Market research demonstrates a significant opportunity for a Canadian investment firm registered in Ontario to expand its client base by targeting a new demographic. The sales team proposes a streamlined client onboarding process to facilitate rapid acquisition of these new clients, but expresses concerns that a rigorous compliance review might slow down their efforts. As the compliance officer for this firm, what is the most appropriate course of action to ensure adherence to Ontario Securities Commission (OSC) regulations? Option A. Proactively engage with the sales team to review their proposed onboarding process. Identify any potential gaps against OSC Rule 31-103 registration requirements, exemptions and ongoing registrant obligations, and collaboratively develop compliance solutions before client acquisition begins. Option B. Allow the sales team to proceed with their streamlined onboarding process and conduct a comprehensive compliance review only after a substantial number of new clients have been onboarded. Option C. Inform the sales team that their concerns about the onboarding process are secondary to the firm's need for rapid client acquisition, and instruct them to implement the streamlined process regardless of potential compliance challenges. Option D. Approve the sales team's onboarding process without a detailed review, trusting their assertion that they are following established procedures and will address any compliance issues if they arise. The correct answer is A. Proactively engage with the sales team to review their proposed onboarding process. Identify any potential gaps against OSC Rule 31-103 registration requirements, exemptions and ongoing registrant obligations, and collaboratively develop compliance solutions before client acquisition begins. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to expand its client base and the regulatory obligation to ensure that all new clients are suitable and properly onboarded. The compliance officer must navigate the pressure to facilitate business growth while upholding the stringent requirements of the Ontario Securities Commission (OSC) regulations regarding client identification and suitability. Failure to do so could result in significant regulatory penalties, reputational damage, and harm to clients. Correct approach analysis. The best professional practice involves a proactive and thorough review of the proposed client onboarding process. This approach prioritizes understanding the specific requirements of OSC Rule 31-103 registration requirements, exemptions and ongoing registrant obligations, particularly those pertaining to Know Your Client (KIC) and suitability assessments. By engaging with the sales team to identify potential gaps and offering concrete solutions that align with regulatory expectations, the compliance officer ensures that the firm's expansion is conducted in a compliant and ethical manner. This demonstrates a commitment to risk mitigation and regulatory adherence, which are core responsibilities of a compliance officer. Incorrect approaches analysis. One incorrect approach involves deferring the compliance review until after the sales team has secured a significant number of new clients. This is problematic because it places the firm in a reactive rather than proactive stance. If the onboarding process is found to be non-compliant after the fact, the firm may have to unwind relationships, face disciplinary action from the OSC for past non-compliance, and incur significant remediation costs. It also signals a lack of commitment to regulatory principles by prioritizing business acquisition over due diligence. Another incorrect approach is to approve the sales team's proposed onboarding process without a detailed review, based solely on the team's assurance that they are doing what they've always done. This is a critical failure because past practices may not have been fully compliant or may no longer meet current OSC standards. It demonstrates a lack of independent oversight and a reliance on potentially flawed assumptions, which is contrary to the compliance officer's duty to ensure adherence to current regulations. Finally, an incorrect approach is to dismiss the sales team's concerns about the onboarding process being too time-consuming, suggesting they simply work harder to meet the requirements. This approach fails to acknowledge the practical challenges of implementation and does not offer constructive solutions. It can create an adversarial relationship and may lead the sales team to cut corners, thereby increasing the risk of non-compliance. A professional compliance officer should aim to facilitate compliance, not create unnecessary barriers or ignore legitimate operational concerns. Professional reasoning. Professionals should adopt a risk-based approach, prioritizing the identification and mitigation of regulatory risks. This involves understanding the specific regulatory landscape, in this case, OSC regulations, engaging collaboratively with business units to understand their objectives and challenges, and developing practical, compliant solutions. A key decision-making framework involves asking, does this process meet the letter and spirit of the relevant regulations? And what are the potential risks to the firm and its clients if this process is not compliant? Proactive engagement and a commitment to finding compliant solutions are paramount. Question 6. During the evaluation of a potential compliance issue within a U.S.-based brokerage firm, the Internal Audit Department has requested immediate, unfettered access to specific client trading records to investigate allegations of unauthorized trading activity. As the compliance officer, what is the most appropriate course of action to ensure adherence to Securities and Exchange Commission (SEC) regulations and protect the firm from potential liability? Option A. Grant the Internal Audit Department direct access to the requested client trading records to expedite the investigation. Option B. Advise the Internal Audit Department that their request cannot be fulfilled due to client confidentiality concerns and close the matter. Option C. Initiate a formal internal investigation, guided by legal counsel, and ensure all data access and review procedures strictly follow the firm's internal policies and relevant SEC rules. Option D. Conduct a brief, informal review of the trading records yourself, without involving legal counsel or formalizing the process. The correct answer is C. Initiate a formal internal investigation, guided by legal counsel, and ensure all data access and review procedures strictly follow the firm's internal policies and relevant SEC rules. Explanation. Scenario analysis. This scenario presents a common challenge for compliance officers, balancing the need for efficient information gathering with the strict requirements of regulatory oversight, specifically concerning the Securities and Exchange Commission (SEC) in the United States. The challenge lies in ensuring that any investigation into potential misconduct is conducted in a manner that is both thorough and legally compliant, avoiding actions that could prejudice the investigation or violate individual rights. The firm's Internal Audit Department's request for direct access to client trading records without proper authorization or a clear investigative protocol creates a significant compliance risk. Correct approach analysis. The best professional practice involves initiating a formal internal investigation under the guidance of legal counsel and in strict adherence to the firm's established policies and SEC regulations. This approach ensures that all information gathering is conducted systematically, with appropriate documentation and oversight. It prioritizes the protection of client confidentiality, while also enabling the compliance department to gather the necessary evidence to assess the alleged misconduct. This method aligns with SEC expectations for robust compliance programs and demonstrates a commitment to ethical conduct and regulatory adherence. Incorrect approaches analysis. One incorrect approach involves granting the Internal Audit Department direct access to client trading records as requested. This bypasses established compliance protocols and potentially violates SEC rules regarding data access and client privacy. It also compromises the integrity of any subsequent investigation by introducing unauthorized data collection methods. Another incorrect approach is to dismiss the Internal Audit Department's concerns without any further investigation. This failure to address potential red flags could lead to a breach of the firm's duty to supervise and could result in significant penalties from the SEC if misconduct is indeed occurring. It demonstrates a lack of diligence and a disregard for the firm's compliance obligations. A third incorrect approach is to conduct a superficial review of the trading records without involving legal counsel or following a structured investigative process. This superficial review might miss critical details, fail to establish a proper audit trail, and ultimately prove insufficient in addressing the potential SEC violations. It risks creating a false sense of security while leaving the firm exposed to regulatory scrutiny. Professional reasoning. Professionals facing such a situation should first recognize the potential regulatory implications. The immediate step is to consult the firm's compliance manual and relevant SEC guidance. The decision-making process should prioritize a structured, legally sound, and ethically responsible investigation. This involves engaging legal counsel early, documenting all steps, and ensuring that any information gathering adheres to established policies and regulations. The goal is to uncover the truth while protecting the firm and its clients from regulatory and legal repercussions. Question 7. What factors determine whether a new digital asset offering by a Delaware-based technology startup seeking to raise capital from a select group of sophisticated investors across the United States must be registered under the Securities Act of 1933, or if an exemption from registration is available. Option A. The nature of the issuer, the characteristics of the digital asset being offered, sophistication and number of potential investors, and the manner in which the offering is conducted. Option B. The general market sentiment towards digital asset offerings at the time of the offering, irrespective of specific legal requirements. Option C. The startup's internal assessment of the offering's compliance, without external legal or regulatory review. Option D. The perceived innovation of the digital asset and the potential for future market growth, regardless of investor protections. The correct answer is A. The nature of the issuer, the characteristics of the digital asset being offered, the sophistication and number of potential investors, and the manner in which the offering is conducted. Explanation. This scenario is professionally challenging because it requires a compliance officer to navigate the nuanced application of the Securities Act of 1933 to a novel offering, balancing the need for investor protection with the potential for innovation in capital formation. The officer must exercise careful judgment to determine if the offering falls within the registration requirements, or if an exemption is available, all while adhering to the specific provisions of U.S. federal securities law. The correct approach involves a thorough analysis of the proposed offering's characteristics against the criteria for available exemptions under the Securities Act of 1933. This includes meticulously examining the nature of the issuer, the offerees, the securities themselves, and the manner of the offering. Specifically, the compliance officer should investigate whether the offering qualifies for exemptions such as Regulation D, Rules 506B or 506C, which permit non-public offerings to accredited investors or a limited number of non-accredited investors, or other applicable exemptions like intrastate offerings. The officer must confirm that all conditions and limitations of the chosen exemption are met, including any filing requirements or restrictions on general solicitation. This approach is correct because it directly addresses the core mandate of the Securities Act of 1933 to ensure that investors receive adequate information for informed investment decisions, either through registration or by demonstrating that the offering structure inherently mitigates the need for full registration due to the sophistication of the investors or the limited scope of the offering. An incorrect approach would be to assume that any offering not explicitly mentioned in the Act requires registration. This fails to recognize the established framework of exemptions that facilitate capital formation for various types of businesses. Another incorrect approach is to rely solely on the issuer's assertion that the offering is private without independently verifying the conditions of any potential exemption. This abdication of due diligence is a significant regulatory failure, as it bypasses the compliance officer's responsibility to ensure adherence to the law. Furthermore, incorrectly applying an exemption, such as misinterpreting the definition of an accredited investor or failing to comply with limitations on general solicitation under Regulation D, would also constitute a serious regulatory and ethical breach, potentially exposing the issuer and the firm to significant penalties and investor harm. Professionals should employ a systematic decision-making process that begins with understanding the fundamental purpose of the Securities Act of 1933. This involves identifying the offering's key features, then researching and applying the relevant provisions of the Act, including its various exemptions. A critical step is to consult legal counsel when the application of the law is complex or uncertain. The process should prioritize investor protection while also considering the practicalities of capital raising, always within the bounds of regulatory compliance. Question 8. Benchmark analysis indicates a financial analyst in New York has acquired beneficial ownership of more than 5% of a class of registered equity securities of a publicly traded company. The analyst believes the acquisition was for passive investment purposes and therefore assumes no immediate filing obligation under the Securities Exchange Act of 1934. Which of the following represents the most appropriate course of action for the analyst to ensure compliance with federal securities laws? Option A. Immediately review Section 13D of the Securities Exchange Act of 1934 and its related rules to determine if a Schedule 13D filing is required, considering the nature of beneficial ownership and the 10-day filing window. Option B. Assume no filing is required because the shares were acquired for passive investment purposes, as this negates the need for disclosure under the Securities Exchange Act of 1934. Option C. File a Schedule 13D only after consulting with legal counsel, even if the 10-day filing window has passed. Option D. Disregard the acquisition as no single purchase exceeded the 5% threshold, and therefore no reporting obligation is triggered under the Securities Exchange Act of 1934. The correct answer is A. Immediately review Section 13D of the Securities Exchange Act of 1934 and its related rules to determine if a Schedule 13D filing is required, considering the nature of beneficial ownership and the 10-day filing window. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a compliance officer to navigate the complex reporting obligations under the Securities Exchange Act of 1934, specifically concerning beneficial ownership. Misinterpreting or failing to adhere to these reporting requirements can lead to significant legal and reputational consequences for both the individual and the firm. The challenge lies in accurately identifying when a reporting obligation is triggered and ensuring timely and correct disclosure. Correct approach analysis. The best professional practice involves a thorough review of the Securities Exchange Act of 1934, particularly Section 13D, and its associated rules, to determine if the acquisition of beneficial ownership of more than 5% of a class of registered equity securities triggers a Schedule 13D filing requirement. This approach correctly identifies that the threshold for reporting is based on beneficial ownership, not just record ownership, and that the intent behind the acquisition, e.g., investment versus control, can be relevant. It prioritizes understanding the specific legal triggers and ensuring compliance with the disclosure timelines mandated by the Act. Incorrect approaches analysis. Failing to file a Schedule 13D when beneficial ownership exceeds 5%, based solely on the belief that the shares were acquired for passive investment purposes, is a regulatory failure. The Securities Exchange Act of 1934 under Section 13D requires disclosure of beneficial ownership exceeding 5%, regardless of investment intent, unless specific exemptions apply. The intent becomes relevant for determining whether a Schedule 13G for passive investors or a Schedule 13D for active investors is required, but the initial reporting threshold is based on ownership percentage. Another incorrect approach is to delay filing the Schedule 13D until after consulting with legal counsel, even though the 5% threshold has been crossed and the acquisition was not for passive investment. The Act mandates filing within 10 days of crossing the threshold. While legal consultation is advisable, it should not supersede the immediate obligation to file within the statutory timeframe. Finally, assuming that no filing is required because the shares were acquired through a series of small, individual purchases over an extended period, without aggregating them to determine the total beneficial ownership, is a significant regulatory oversight. The Act requires aggregation of beneficial ownership, meaning all shares acquired by an individual or group with a common purpose are counted towards the 5% threshold. Professional reasoning. Professionals should adopt a proactive and diligent approach to understanding and complying with reporting obligations. This involves staying current with relevant securities laws, such as the Securities Exchange Act of 1934, and understanding the nuances of beneficial ownership and filing requirements. When in doubt, seeking expert legal counsel is crucial, but it should be done in conjunction with, not as a substitute for, timely compliance with statutory obligations. A robust internal compliance program that includes regular training and clear procedures for identifying and reporting significant ownership changes is essential. Question 9. Strategic planning requires a compliance officer in Ontario to accurately identify the appropriate regulatory body for reporting suspected insider trading activity by a registered firm. Given the firm operates solely within Ontario and the suspected activity pertains to trading securities listed on a Canadian exchange, which regulatory agency should be the primary recipient of this report? Option A, the Canadian Securities Administrators, CSA. Option B, the Ontario Securities Commission, OSC. Option C, the Investment Industry Regulatory Organization of Canada, IIROC. Option D, the Ontario Provincial Police, OP. The correct answer is B, the Ontario Securities Commission, OSC. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a compliance officer to navigate the complexities of overlapping regulatory jurisdictions and determine the appropriate authority for reporting a potential violation. Misidentifying the correct regulator can lead to delayed enforcement, missed opportunities for remediation, and potential sanctions for the firm and the officer themselves. Careful judgment is required to ensure compliance with all applicable laws and regulations. Correct approach analysis. The best professional practice involves identifying the primary regulator with direct oversight over the specific activity or entity in question. In this case, the Ontario Securities Commission, OSC, is the provincial securities regulator responsible for overseeing the trading of securities and the conduct of market participants within Ontario. Therefore, reporting the suspected insider trading activity to the OSC is the most direct and effective way to initiate an investigation and ensure regulatory compliance. The OSC has the mandate and resources to investigate such matters thoroughly. Incorrect approaches analysis. Reporting the suspected insider trading to the Ontario Provincial Police, OP, would be an incorrect approach because while the OPP handles criminal matters, securities violations are primarily within the purview of the OSC. While there might be an overlap in some cases, the OSC is the specialized regulator equipped to handle securities-related investigations and enforcement. Reporting to the Investment Industry Regulatory Organization of Canada, IIROC, is also not the primary approach for a suspected violation of Ontario securities law. IIROC is a self-regulatory organization, SRO, that enforces rules of conduct for its member firms and individuals, but the ultimate regulatory authority for securities law in Ontario rests with the OSC. While IIROC might be notified as part of an internal compliance process, or if the firm is an IIROC member, it is not the direct regulatory agency for initiating an investigation into a breach of provincial securities legislation. Reporting to the Canadian Securities Administrators, CSA, is also not the most direct approach. The CSA is a council of securities regulators from across Canada, and while it coordinates regulatory efforts, individual provincial regulators like the OSC are responsible for enforcement within their respective jurisdictions. Professional reasoning. Professionals should approach such situations by first identifying the specific nature of the suspected violation. Then, they should determine which regulatory body has primary jurisdiction over that type of activity or entity. Consulting internal compliance policies and seeking guidance from senior compliance personnel or legal counsel can also be crucial steps in ensuring the correct regulatory path is followed. The goal is always to ensure timely and effective reporting to the appropriate authority to uphold regulatory integrity and protect investors. Question 10. The monitoring system demonstrates a 250% increase in the daily trading volume executed by portfolio manager Mr. Sterling in a specific small-cap stock, representing 40% of the total daily volume for that stock on the London Stock Exchange. Mr. Sterling's historical average daily trade count in this stock over the past 6 months has been 15 trades, and his trades typically represent no more than 5% of the total daily volume. The firm's surveillance policy states that an alert should be generated for a portfolio manager if their daily trade count in a single stock exceeds their historical average by more than 150%, or if their trades constitute more than 15% of the total daily volume in that stock, whichever threshold is breached first. Which of the following actions should the compliance officer take as the immediate next step in their review? Option A. Dismiss the activity as potentially normal for a portfolio manager actively managing a position in a thinly traded stock and monitor for future occurrences. Option B. Focus solely on the absolute number of trades, 250% increase, and initiate a review of Mr. Sterling's personal trading account for any potential conflicts of interest. Option C. Calculate the percentage increase in Mr. Sterling's trade count and the percentage of total daily volume his trades represent. Compare these to the firm's policy thresholds, and if either is breached, initiate a review of the trading rationale and any associated news or research. Option D. Immediately escalate the matter to senior management for an investigation, given the significant deviation from Mr. Sterling's typical trading activity. The correct answer is C. Calculate the percentage increase in Mr. Sterling's trade count and the percentage of total daily volume his trades represent. Compare these to the firm's policy thresholds, and if either is breached, Initiate a review of the trading rationale and any associated news or research. Explanation. The monitoring system demonstrates a significant increase in the volume of trades executed by a specific portfolio manager, Mr. Sterling, within a short period, particularly in a thinly traded stock. This scenario is professionally challenging because it requires the compliance officer to balance the need for efficient trading operations with the imperative to detect and prevent potential market abuse, such as insider trading or market manipulation. The compliance officer must exercise careful judgment to distinguish between legitimate trading activity and suspicious behavior, ensuring that the firm's surveillance procedures are robust and effectively applied. The best approach involves a multifaceted review that quantifies the deviation from Mr. Sterling's historical trading patterns and benchmarks it against industry norms for similar asset classes and market conditions. This includes calculating the percentage increase in trade volume and the proportion of total daily volume Mr. Sterling's trades represent. The compliance officer should then compare these metrics to predefined thresholds established in the firm's surveillance policy, which are designed to trigger further investigation. If these metrics exceed the established thresholds, the next step is to review the underlying rationale for these trades, such as news releases, analyst reports, or client orders, and a cross-reference with Mr. Sterling's known information flow. This approach is correct because it is data-driven, objective, and directly aligns with the principles of effective surveillance as outlined in the Financial Conduct Authority (FCA) Handbook, specifically in the Conduct of Business Sourcebook (COBS), and the Market Abuse Regulation (MAR). It prioritizes quantitative analysis to identify anomalies and then employs qualitative review to understand the context, thereby fulfilling the firm's obligation to have adequate arrangements and procedures to prevent market abuse. An incorrect approach would be to solely focus on the absolute number of trades without considering the context of Mr. Sterling's historical activity or the market's liquidity. For instance, if the firm's policy only requires an alert for trades exceeding 100 per day, and Mr. Sterling executed 110 trades, this approach might trigger an alert even if 110 trades represent a significant decrease from his usual activity or are a normal occurrence in a highly liquid market. This fails to identify true deviations and could lead to an inefficient allocation of compliance resources. Another incorrect approach would be to dismiss the increased trading volume simply because Mr. Sterling is a senior portfolio manager with a history of active trading. While seniority and past activity are factors, they do not exempt a trader from scrutiny. The firm's surveillance procedures must apply consistently, and a significant deviation from a trader's own baseline, regardless of their position, warrants investigation. This approach risks overlooking potential misconduct by senior personnel. A further incorrect approach would be to rely solely on anecdotal evidence or personal judgment without quantitative support. For example, if a compliance officer feels that the trading activity is unusual but cannot articulate specific metrics or thresholds that have been breached, the investigation lacks objectivity and may be challenged. This approach fails to meet the evidential requirements for a thorough compliance review and could lead to missed red flags or unjustified accusations. The professional reasoning framework for such situations involves a systematic process. First, understanding the firm's established surveillance policies and the specific thresholds for triggering alerts. Second, utilizing the monitoring system's data to perform quantitative analysis, calculating deviations and comparing them to historical patterns and benchmarks. Third, if thresholds are breached, conducting a qualitative review of the trading activity, considering all relevant contextual information. And finally, documenting the entire process and the rationale for any conclusions reached, ensuring transparency and auditability. Question 11. Operational review demonstrates that a block trade executed by your firm in New York was crossed outside the prevailing NYSE quotation. As a compliance officer for a firm registered in New York, what is the most appropriate initial step to take to assess compliance with NYSE Rule 127? Option A. Accept the trading desk's verbal assurance that the trade was executed in compliance with NYSE rules without further investigation. Option B. Focus solely on the size of the block trade to determine if it meets the threshold for an exception under NYSE Rule 127. Option C. Review the firm's records to confirm the execution price provided superior value compared to the prevailing national best bid or offer, NBBO, at the time of the order, and verify adherence to internal policies for such trades. Option D. Immediately issue a warning to the trading desk for executing the trade outside the NYSE quotation, assuming a rule violation. The correct answer is C. Review the firm's records to confirm the execution price provided superior value compared to the prevailing national best bid or offer (NBBO) at the time of the order, and verify adherence to internal policies for such trades. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a compliance officer to interpret and apply a specific NYSE rule, Rule 127, in a real-time trading context. The core challenge lies in distinguishing between legitimate block crosses executed outside the prevailing NYSE quotation and those that might indicate manipulative trading practices or a failure to seek the best execution. The compliance officer must balance the need for efficient trading with the regulatory imperative to protect market integrity and investor interests. This requires a nuanced understanding of market mechanics and the intent behind the rule. Correct approach analysis. The best professional practice involves a thorough review of the trade details and the firm's internal procedures. This approach correctly identifies that the primary responsibility is to ensure the firm's trading desk adhered to NYSE Rule 127 by demonstrating that the block cross was executed at a price superior to the prevailing national best bid or offer, NBBO, at the time of the order. This involves examining the firm's records to confirm that the execution price was indeed more advantageous for the client than what was available on the exchange. Furthermore, it requires verifying that the firm had established and followed internal policies and procedures designed to identify and execute such block crosses in compliance with the rule, including any pre-trade compliance checks or post-trade surveillance. This aligns directly with the spirit and letter of NYSE Rule 127, which permits such crosses under specific conditions designed to benefit clients. Incorrect approaches analysis. One incorrect approach involves immediately assuming a violation occurred simply because the trade was executed outside the prevailing NYSE quotation. This fails to acknowledge that NYSE Rule 127 specifically allows for such executions under certain conditions, primarily when the execution price is demonstrably better for the client than the NBBO. This approach is overly punitive and lacks the necessary due diligence to understand the context of the trade. Another incorrect approach is to rely solely on the trading desk's assertion that the trade was compliant without independent verification. While the trading desk is responsible for executing trades, the compliance department's role is to independently assess adherence to rules. This approach abdicates the compliance function and creates a significant regulatory risk by not performing adequate oversight. A further incorrect approach is to focus only on the volume of the block trade without considering the execution price relative to the NBBO. NYSE Rule 127 is concerned with the price improvement achieved for the client, not merely the size of the transaction. Ignoring the price aspect means the core requirement of the rule is not being assessed. Professional reasoning. Professionals facing such situations should adopt a systematic, evidence-based approach. First, clearly identify the relevant regulation, NYSE Rule 127. Second, understand the conditions under which the rule permits exceptions or specific trading practices. Third, gather all relevant trade data, including timestamps, execution prices, and prevailing NBBO quotes at the time of execution. Fourth, review the firm's internal policies and procedures related to block trading and best execution. Fifth, conduct an independent analysis of the trade against the rule's requirements and the firm's procedures. If discrepancies or potential violations are found, escalate appropriately and take corrective action. This structured process ensures thoroughness and adherence to regulatory obligations. Question 12. Process analysis reveals a potential for sales representatives in Ontario to emphasize product features that align with current sales incentives, potentially overshadowing a client's stated investment objectives. As a compliance officer for a registered firm operating in Ontario, which of the following actions would best uphold the firm's regulatory obligations and ethical standards concerning sales practices? Option A. Focus compliance efforts on monitoring trading volumes and revenue generation, with sales practice reviews being a secondary concern addressed only if significant regulatory inquiries arise. Option B. Conduct a comprehensive review of all sales scripts, training materials, and incentive programs to ensure they explicitly promote suitability, client best interests, and fair dealing, and provide targeted retraining where gaps are identified. Option C. Assume that sales representatives, having completed their initial licensing, possess sufficient knowledge to independently apply suitability rules in all client interactions. Option D. Implement a system to track client complaints related to sales recommendations and only investigate potential issues once a significant number of complaints are received. The correct answer is B. Conduct a comprehensive review of all sales scripts, training materials, and incentive programs to ensure they explicitly promote suitability, client best interests, and fair dealing, and provide targeted retraining where gaps are identified. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a compliance officer to balance the firm's sales objectives with the paramount duty to protect clients from potentially unsuitable recommendations. The pressure to meet sales targets can create an environment where the temptation to push products, even if not perfectly aligned with client needs, may arise. The compliance officer must exercise sound judgment to ensure that sales practices adhere strictly to regulatory requirements and ethical standards, preventing harm to clients and reputational damage to the firm. Correct approach analysis. The best professional practice involves a proactive and thorough review of sales scripts and training materials to ensure they emphasize suitability and client best interests. This approach is correct because it directly addresses the root cause of potential sales practice violations by embedding compliance principles into the sales process from the outset. Specifically, under the Ontario Securities Commission (OSC) regulation, particularly those related to client-advisor relationships and suitability obligations, e.g., National Instrument 31-103 registration requirements, exemptions, and ongoing registrant obligations. Registrants have a fundamental obligation to deal fairly, honestly, and in good faith with clients. This includes ensuring that recommendations are suitable for the client's investment objectives, risk tolerance, and financial circumstances. By scrutinizing sales materials and training, the compliance officer actively promotes adherence to these core principles, thereby mitigating the risk of misrepresentation or unsuitable recommendations. Incorrect approaches analysis. One incorrect approach involves relying solely on post-sale monitoring of client complaints and trading activity to identify sales practice issues. This is professionally unacceptable because it is reactive rather than proactive. While monitoring is a necessary component of compliance, it fails to prevent violations from occurring in the first place. By the time a complaint is lodged or a pattern of problematic trades emerges, a client may have already suffered financial harm. This approach neglects the OSC's emphasis on robust internal controls and supervision designed to prevent misconduct. Another incorrect approach is to assume that sales staff will inherently understand and apply suitability rules without explicit guidance and reinforcement. This is professionally unacceptable as it demonstrates a lack of due diligence and oversight. Regulatory frameworks, including those in Ontario, place a clear onus on registrants to supervise their employees and ensure they are adequately trained and informed about their obligations. Relying on implicit understanding is a recipe for inconsistent application of rules and potential breaches of client trust and regulatory requirements. A further incorrect approach is to prioritize sales volume and revenue generation over the detailed examination of sales practices. This is professionally unacceptable because it signals a misalignment of priorities that can foster a culture where compliance is secondary to profit. The OSC, like other securities regulators, expects firms to have a strong compliance culture where client protection is a fundamental value. Ignoring potential issues in sales practices due to a focus on revenue directly contravenes this expectation and increases the likelihood of regulatory sanctions and client harm. Professional reasoning. Professionals should adopt a risk-based, proactive approach to compliance. This involves identifying potential areas of regulatory and ethical vulnerability, such as sales practices, and implementing controls and procedures to mitigate those risks before they materialize. A robust compliance program requires continuous evaluation and adaptation, with a focus on embedding ethical conduct and regulatory adherence into the daily operations of the firm. When faced with potential conflicts between business objectives and compliance obligations, professionals must always err on the side of client protection and regulatory integrity, seeking guidance and escalating concerns as necessary. Question 13. The evaluation methodology shows that a compliance officer in Ontario, Canada, is tasked with enhancing the firm's compliance monitoring activities to ensure adherence to Ontario securities law. Considering the firm's limited resources and the importance of maintaining employee morale, which of the following approaches would best achieve effective compliance monitoring while minimizing negative impacts? Option A. Rely primarily on employee self-declarations and voluntary disclosures as the main method for identifying and reporting compliance issues. Option B. Institute a comprehensive, high-frequency monitoring of all employee communications and transactions, irrespective of their inherent risk profile. Option C. Implement a risk-based monitoring program that prioritizes oversight of activities with the highest potential for regulatory breaches under Ontario securities law, allocating resources accordingly. Option D. Focus compliance monitoring efforts exclusively on activities that have already been identified as problematic by external regulators or through internal whistleblower complaints. The correct answer is C. Implement a risk-based monitoring program that prioritizes oversight of activities with the highest potential for regulatory breaches under Ontario securities law, allocating resources accordingly. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a compliance officer in Ontario, Canada, to balance the need for robust compliance monitoring with the practical constraints of limited resources and the potential for negative impact on employee morale. The compliance officer must identify monitoring activities that are both effective in detecting regulatory breaches under Ontario securities law and efficient in their use of resources, while also considering the perception and impact on the firm's employees. A failure to strike this balance could lead to either ineffective compliance, regulatory sanctions, or an overly punitive and demotivating work environment. Correct approach analysis. The best approach involves a risk-based methodology that prioritizes monitoring activities based on the likelihood and potential impact of noncompliance with Ontario securities law. This means focusing resources on areas with the highest inherent risk, such as complex trading strategies, client onboarding for high-risk individuals, or areas where past issues have been identified. This approach aligns with the principles of effective compliance outlined by the Ontario Securities Commission (OSC), which emphasizes a proactive and proportionate response to regulatory obligations. By concentrating efforts on high-risk areas, the compliance officer can maximize the effectiveness of monitoring within resource constraints, ensuring that the most significant compliance risks are adequately addressed. This also demonstrates a commitment to fulfilling regulatory duties without unnecessarily burdening all employees with intrusive oversight. Incorrect approaches analysis. One incorrect approach involves implementing a blanket, high-frequency monitoring of all employee activities, regardless of risk. This is inefficient and can create a culture of distrust, negatively impacting morale and potentially leading to employees finding ways to circumvent oversight rather than fostering a compliant environment. It also diverts resources from genuinely high-risk areas, making overall compliance monitoring less effective. This approach fails to adhere to the OSC's guidance on proportionality and risk-based compliance. Another incorrect approach is to solely rely on employee self-reporting for compliance. While self-reporting is a component of a compliance program, it is insufficient as the primary monitoring mechanism. It does not provide independent verification and is susceptible to omissions or misrepresentations, especially in areas where employees might fear repercussions. This approach significantly increases the risk of undetected breaches of Ontario securities law, which is a direct failure of the compliance officer's duty to ensure adherence to regulations. Further incorrect approach is to only monitor activities that are explicitly flagged by external regulators or internal whistleblowers. This reactive approach means that compliance monitoring is only initiated after a problem has already occurred or been reported. It fails to proactively identify and mitigate potential risks before they materialize into breaches of Ontario securities law, which is a fundamental expectation of a robust compliance function. This approach is not aligned with the proactive risk management principles advocated by regulatory bodies. Professional reasoning. Professionals should adopt a systematic, risk-based approach to compliance monitoring. This involves 1. Risk assessment. continuously identify and assess the inherent risks of noncompliance with Ontario securities law across all business activities and employee functions. 2. Prioritization. Allocate monitoring resources and efforts to areas with the highest assessed risk, considering both the likelihood of a breach and its potential impact. 3. Diverse monitoring tools. Employ a range of monitoring techniques, including data analytics, transaction surveillance, policy reviews, and targeted employee interviews, tailored to the specific risks being monitored. 4. Regular review and adaptation. Periodically review the effectiveness of monitoring activities and adapt the methodology based on emerging risks, regulatory changes, and internal findings. 5. Communication and training. Foster a culture of compliance through clear communication of policies and expectations, and provide ongoing training to employees. Question 14. The audit findings indicate that a brokerage firm operating in California has consistently applied markups on certain over-the-counter securities that appear higher than the prevailing market price, with the firm's internal documentation citing market conditions as justification. As a compliance officer, which of the following actions best addresses this situation in accordance with FINRA Rule 2121? Option A. Conduct a detailed analysis of the firm's markups by comparing the prices at which the firm sold the securities to customers with the prevailing market prices for those same securities at the time of the transactions, considering the size of the trades and the services rendered by the firm. Option B. Focus the review on the overall profitability of the firm's trading desk, as higher markups would naturally contribute to increased profits. Option C. Investigate whether any customers have lodged formal complaints regarding the firm's pricing practices before initiating a deeper review of the markups. Option D. Accept the firm's internal documentation stating market conditions as sufficient justification for the observed markups, assuming the firm is acting in good faith. The correct answer is A. Conduct a detailed analysis of the firm's markups by comparing the prices at which the firm sold the securities to customers with the prevailing market prices for those same securities at the time of the transactions, considering the size of the trades and the services rendered by the firm. Explanation. The audit findings indicate a potential violation of FINRA Rule 2121, Fair Prices and Commissions, in the state of California. This scenario is professionally challenging because it requires a compliance officer to not only identify potential rule breaches, but also to distinguish between acceptable business practices and those that exploit customers or create unfair market advantages. The core of FINRA Rule 2121 is ensuring that customers receive fair prices and commissions, which means that the prices at which securities are bought and sold, and the commissions charged, must be fair and reasonable in relation to the market. This involves considering various factors, including the prevailing market price, the size of the transaction, and the services rendered. The best professional approach involves a thorough review of the firm's pricing policies and a comparison of actual transaction prices and commissions against prevailing market conditions for similar securities at the time of the trades. This includes examining the firm's markups and markdowns on principal transactions and the commissions charged on agency transactions. The compliance officer must assess whether these were within reasonable limits, considering the specific security, market volatility, and the firm's role in the transaction. This approach is correct because it directly addresses the spirit and letter of FINRA Rule 2121 by focusing on the fairness of prices and commissions in relation to market realities and the services provided. It demonstrates a proactive and diligent effort to uphold regulatory standards and protect customer interests. An incorrect approach would be to simply accept the firm's stated rationale for its pricing without independent verification. For instance, relying solely on the firm's assertion that its pricing reflects market value without conducting an independent analysis of actual market prices and comparable transactions would be a failure. This approach is ethically and regulatorily deficient because it abdicates the responsibility to critically evaluate the fairness of prices and commissions, potentially allowing for excessive markups or markdowns that violate Rule 2121. Another incorrect approach would be to focus only on the profitability of the transactions for the firm, rather than the fairness of the prices to the customer. While profitability is a business concern, FINRA Rule 2121 is specifically designed to prevent the firm from profiting unfairly at the customer's expense. Ignoring the customer's perspective and the prevailing market prices in favor of internal profit metrics is a direct contravention of the rule's intent. Finally, an incorrect approach would be to dismiss the audit findings based on the fact that the firm has not received any customer complaints regarding pricing. The absence of complaints does not equate to fair pricing. Customers may not be aware that they have been overcharged, or they may not have the expertise to identify unfair pricing. A responsible compliance officer must proactively ensure fair practices, not merely react to customer grievances. The professional decision-making process for similar situations should involve a systematic evaluation of audit findings against relevant regulations. This includes understanding the specific requirements of rules like FINRA Rule 2121, gathering all necessary data, performing independent analysis, considering the impact on customers, and documenting all findings and actions taken. The focus should always be on upholding regulatory obligations and ethical standards to protect investors and maintain market integrity. Question 15. Quality control measures reveal that a broker-dealer in New York is planning to engage in significant proprietary trading in a security for which it is also acting as a lead underwriter in an upcoming offering. The firm's trading desk believes that the security is undervalued and anticipates a price increase, intending to profit from this anticipated rise while simultaneously participating in the distribution. What is the most appropriate course of action for the firm's compliance officer to ensure adherence to the Securities Exchange Act of 1934, specifically Regulation M? Option A. Proceed with the trading strategy, assuming that the firm's intent to profit and the trading volume are not substantial enough to be considered manipulative under Regulation M. Option B. Conduct a thorough review of the proposed proprietary trading strategy in light of Regulation M's restrictions on distribution participants and affiliated purchasers, advising the trading desk to modify or suspend the activity if it poses a risk of artificial price influence until the underwriting is completed or a clear exemption is established. Option C. Rely on the trading desk's assurance that the proposed trades are permissible and do not violate any regulations. Option D. Argue that since the firm is not the sole underwriter and other market participants are active, the firm's trading will not have a material impact on the security's price and therefore is permissible. The correct answer is B. Conduct a thorough review of the proposed proprietary trading strategy in light of Regulation M's restrictions on distribution participants and affiliated purchasers, advising the trading desk to modify or suspend the activity if it poses a risk of artificial price influence until the underwriting is completed or a clear exemption is established. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a compliance officer to navigate the complex interplay between a firm's proprietary trading activities and the restrictions imposed by Regulation M of the Securities Exchange Act of 1934. The firm's desire to profit from an anticipated price increase in a security it intends to underwrite, while simultaneously engaging in trading that could influence that security's price, creates a direct conflict with the anti-manipulation provisions of Regulation M. The compliance officer must exercise careful judgment to ensure the firm's actions do not violate federal securities laws, which could lead to significant regulatory penalties, reputational damage, and harm to investors. Correct approach analysis. The best professional practice involves proactively identifying the potential conflict and implementing a robust compliance framework to prevent violations. This includes thoroughly reviewing the firm's trading strategy in relation to the upcoming underwriting to determine if it falls under any of the prohibited activities or exceptions within Regulation M. If the trading strategy appears to pose a risk of manipulation or artificial price influence, the compliance officer should advise the trading desk to modify or suspend the activity until the underwriting is completed or a clear exemption under Regulation M can be established. This approach prioritizes adherence to the spirit and letter of the law, safeguarding the integrity of the market and the firm's reputation. Incorrect approaches analysis. One incorrect approach is to proceed with the trading strategy without a thorough review, assuming that the firm's intent to profit is sufficient justification and that the trading volume is not substantial enough to be considered manipulative. This fails to recognize that Regulation M prohibits activities that could be deemed manipulative, regardless of intent or the perceived impact of the trading. The focus is on the potential for artificial price influence, not solely on the intent to manipulate. Another incorrect approach is to rely solely on the advice of the trading desk that the proposed trades are permissible. While input from the trading desk is valuable, the ultimate responsibility for ensuring compliance with federal securities laws rests with the compliance department. Delegating this critical judgment to the business unit without independent verification is a significant ethical and regulatory failure. A third incorrect approach is to argue that since the firm is not the sole underwriter and other market participants are active, the firm's trading will not have a material impact. Regulation M's restrictions apply to the activities of distribution participants and affiliated purchasers, and the focus is on preventing their actions from artificially influencing the price, irrespective of the actions of other market participants. The potential for influence, even if not guaranteed to be decisive, is the concern. Professional reasoning. Professionals should employ a risk-based approach to compliance. This involves understanding the specific regulatory requirements applicable to the firm's activities, identifying potential areas of conflict or noncompliance, and implementing controls to mitigate those risks. When faced with ambiguity or a potential conflict, the default position should be to err on the side of caution and seek clarification, or modify the activity to ensure compliance. This proactive and diligent approach is essential for maintaining market integrity and protecting the firm from regulatory sanctions. Question 16. Stakeholder feedback indicates a need for improved efficiency in responding to regulatory inquiries. An Ontario Securities Commission OSC investigator has requested the daily trading activities for a specific client for the past 6 months. As a compliance officer in Ontario, what is the most appropriate and compliant approach to retrieve and provide this information? Option A. Manually compile the trading activity by accessing individual client statements and trade confirmations from various archive sources to piece together the required information. Option B. Confirm the scope and authority of the OSC request, then use the firm's approved systems and documented procedures to retrieve only the specifically requested trading activity, ensuring an audit trail is maintained. Option C. Immediately download all available daily trading activity records for the client from all accessible systems without further verification, as the OSC has requested it. Option D. Inform the OSC investigator that no trading activity data can be provided without a formal court order, regardless of the nature of the inquiry. The correct answer is B. Confirm the scope and authority of the OSC request, then use the firm's approved systems and documented procedures to retrieve only the specifically requested trading activity, ensuring an audit trail is maintained. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a compliance officer to balance the need for efficient retrieval of information for regulatory inquiries with the paramount duty to protect client confidentiality and adhere to data privacy regulations. Misinterpreting or mishandling customer trading activity data can lead to significant regulatory penalties, reputational damage, and erosion of client trust. The compliance officer must demonstrate a nuanced understanding of both the firm's internal policies and the specific requirements of the Ontario Securities Commission. OSC. Correct approach analysis. The best professional practice involves a systematic and documented approach to retrieving customer daily trading activities for regulatory inquiries. This entails first confirming the legitimacy and scope of the OSC's request, then utilizing the firm's approved systems and procedures to access the data. This approach ensures that only necessary information is retrieved, that the retrieval process is auditable, and that client data is handled with appropriate security and confidentiality. It directly aligns with the OSC's expectations for cooperation with investigations, while upholding the firm's obligations under Ontario privacy laws and securities regulations, such as those requiring firms to maintain adequate records and assist regulators. Incorrect approaches analysis. One incorrect approach involves immediately downloading all available daily trading activity for the specified client without verifying the request's specificity or consulting internal policies. This is problematic because it risks overcollection of data, potentially exposing sensitive client information beyond what is required by the OSC, thereby violating principles of data minimization and client confidentiality. It also bypasses necessary internal controls and documentation, which could be viewed as a failure to maintain proper records as mandated by securities regulations. Another incorrect approach is to refuse to provide any trading activity data until a formal court order is presented, even for a routine OSC inquiry. While a court order is necessary for certain types of information, many regulatory bodies have statutory powers to request information directly. Unnecessarily delaying or refusing cooperation without proper justification can be seen as obstructing a regulatory investigation, a serious offense under securities law. It also fails to acknowledge the collaborative relationship expected between regulated entities and the OSC. A third incorrect approach is to manually compile the trading activity from various disparate sources without using the firm's designated systems or creating a clear audit trail. This method is prone to errors, omissions, and inconsistencies, making the retrieved data unreliable. Furthermore, it bypasses the firm's established data security protocols and audit mechanisms, increasing the risk of data breaches and failing to meet the regulatory requirement for accurate and complete record keeping. Professional reasoning. When faced with a regulatory inquiry, a compliance officer should always begin by understanding the nature and authority of the request. This involves verifying the requesting body's jurisdiction and the legal basis for their information demand. Next, the officer must consult the firm's internal policies and procedures for handling such requests, which typically outline approved methods for data retrieval and reporting. The principle of least privilege should guide data collection, meaning only the minimum necessary information should be accessed and provided. Maintaining a clear, auditable record of all actions taken, including the request itself, the data retrieved, and the individuals involved, is crucial for demonstrating compliance and protecting the firm. Question 17. Governance review demonstrates that an Ontario-based investment firm's IT department has proposed a significant consolidation of client records and communication logs into a new, centralized digital archive, citing enhanced efficiency and data security. As the firm's compliance officer, what is the most appropriate initial step to ensure adherence to Ontario Securities Commission (OSC) record-keeping regulations? Option A. Conduct a detailed assessment of the proposed consolidation against the specific requirements of OSC Rule 19-501 and other relevant Ontario securities legislation, focusing on record accessibility, integrity, and retention periods. Option B. Implement the consolidation and subsequently notify the OSC of the new record-keeping system for their review. Option C. Immediately approve the consolidation plan, relying on the IT department's assurances regarding data integrity and the efficiency benefits. Option D. Reject the consolidation proposal outright to avoid any potential compliance risks, without further investigation. The correct answer is A. Conduct a detailed assessment of the proposed consolidation against the specific requirements of OSC Rule 19-501 and other relevant Ontario securities legislation, focusing on record accessibility, integrity, and retention periods. Explanation. Scenario analysis. This scenario presents a challenge for a compliance officer in Ontario, Canada, as it requires balancing the firm's operational efficiency with the stringent record-keeping obligations mandated by the Ontario Securities Commission (OSC). The firm's desire to streamline processes by consolidating records risks compromising the integrity and accessibility of information crucial for regulatory oversight and internal audits. The compliance officer must navigate this tension, ensuring that any proposed solution adheres strictly to OSC Rule 19-501 regarding continuous disclosure obligations and related record-keeping provisions, without sacrificing the ability to reconstruct client transactions and communications. Correct approach analysis. The best professional practice involves a thorough review of the firm's current record-keeping systems against the specific requirements of OSC Rule 19-501 and any other applicable Ontario securities legislation. This approach prioritizes understanding the regulatory mandate first, then assessing how the firm's proposed consolidation aligns with these requirements. It necessitates identifying which records are subject to specific retention periods and accessibility standards, and then determining if the consolidation method preserves these attributes. This ensures that the firm remains compliant with its legal obligations to maintain accurate, complete, and readily accessible records for the prescribed periods, facilitating regulatory inspections and internal investigations. Incorrect approaches analysis. One incorrect approach is to immediately approve the consolidation based solely on the IT department's assurance of data integrity and efficiency gains. This fails to acknowledge that regulatory compliance is not solely a technical matter, but a legal and operational one. The OSC's requirements are not merely about data existence, but about its format, accessibility, and the ability to reconstruct events, which a purely technical assurance might not fully address. Another incorrect approach is to reject the consolidation outright without a detailed assessment of its potential impact on regulatory compliance. While caution is warranted, a blanket refusal without exploring potential compliance solutions could hinder the firm's operational improvements unnecessarily and might not be the most constructive way to address the issue. A further incorrect approach is to implement the consolidation and then inform the OSC of the change, seeking retrospective approval. This is a significant regulatory failure, as it bypasses the proactive duty to ensure compliance. Regulatory bodies expect firms to have robust systems in place before making changes that affect record keeping, not to seek permission after the fact. Professional reasoning. Professionals in Ontario must adopt a proactive and risk-based approach to compliance. When faced with proposed changes that impact record keeping, the decision-making process should begin with a clear understanding of the relevant regulatory framework, in this case, OSC rules. This understanding should then be applied to the specific proposal, evaluating its potential impact on compliance obligations. If the proposal appears to conflict with regulations, the next step is to explore modifications that would bring it into compliance, rather than simply accepting or rejecting it. Open communication with the relevant departments, like IT, and, where necessary, seeking clarification from the regulator, are crucial components of responsible decision-making. Question 18. Compliance review shows that a registered firm operating in Ontario, Canada, is developing its internal surveillance program. Which of the following approaches best aligns with the Ontario Securities Commission's expectations for effective internal and external data utilization for surveillance purposes? Option A. Develop a risk-based surveillance framework that integrates relevant internal data, e.g., trading activity, communications, with carefully selected external data, e.g., market news, regulatory announcements, and is regularly reviewed and updated based on identified risks and regulatory changes. Option B. Implement a broad data collection strategy that gathers every piece of internal and external data possible, without a specific risk assessment, to ensure no potential violation is missed, regardless of data relevance or privacy implications. Option C. Establish a fixed surveillance system based on initial risk assessments and maintain it without modifications, unless a significant regulatory breach is explicitly identified by external parties. Option D. Focus exclusively on collecting and analyzing all available internal trading data, assuming that any misconduct will be evident solely from the firm's own transaction records. The correct answer is A. Develop a risk-based surveillance framework that integrates relevant internal data, e.g., trading activity, communications, with carefully selected external data, e.g., market news, regulatory announcements, and is regularly reviewed and updated based on identified risks and regulatory changes. Explanation. Scenario analysis. This scenario presents a common challenge for compliance officers in Ontario, Canada, where the regulatory landscape for financial services is governed by provincial securities commission like the Ontario Securities Commission, OSC. The challenge lies in balancing the need for comprehensive surveillance with the practical limitations of data availability and the potential for data privacy concerns. A compliance officer must develop a robust surveillance framework that is both effective in detecting misconduct and compliant with OSC regulations, particularly concerning the use and protection of client and firm data. The difficulty arises from identifying the most appropriate data sources and methodologies that satisfy regulatory expectations without overstepping boundaries or creating undue operational burdens. Correct approach analysis. The best approach involves a multifaceted strategy that leverages both internal and external data sources, tailored to the specific risks identified within the firm's operations in Ontario. This includes utilizing internal trading data, communication logs, and client account information, alongside carefully selected external data such as market news feeds, regulatory filings, and potentially anonymized industry trend data. The development and modification of surveillance system should be driven by a risk-based assessment, ensuring that the chosen data points and analytical tools are directly relevant to detecting potential violations of Ontario securities laws and regulations, such as those outlined in National Instrument 31-103 registration requirements, exemptions, and ongoing registrant obligations. This approach is correct because it is proactive, risk mitigating, and directly aligned with the OSC's mandate to protect investors and maintain fair and efficient capital markets. It demonstrates a commitment to a comprehensive and adaptable surveillance program. Incorrect approaches analysis. One incorrect approach would be to solely rely on internal data without considering relevant external market indicators or news. This is flawed because it creates blind spots. For instance, a firm might not detect market manipulation if it doesn't correlate internal trading activity with significant market events or news that could be a catalyst for such activity. This failure to incorporate external context can lead to missed red flags and noncompliance with the spirit of robust surveillance expected by the OSC. Another incorrect approach is to indiscriminately collect all available data, both internal and external, without a clear risk assessment or analytical framework. This is inefficient and can lead to data overload, making it difficult to identify genuine threats. Furthermore, it may raise privacy concerns and violate data protection principles under Ontario law, such as the Personal Information Protection and Electronic Documents Act, PIPEDA. If not handled appropriately, even though PIPEDA is federal, provincial privacy laws also apply, and the OSC expects responsible data handling. The OSC expects a targeted and effective surveillance program, not a data hoarding exercise. A third incorrect approach is to implement a surveillance system that is static and not regularly reviewed or updated in response to evolving market practices, new regulatory guidance from the OSC, or identified internal control weaknesses. This lack of adaptability means the surveillance system may quickly become outdated and ineffective, failing to detect emerging risks or new forms of misconduct. This passive approach is contrary to the proactive and dynamic nature of effective compliance required by securities regulators. Professional reasoning. Compliance officers in Ontario must adopt a risk-based, adaptive, and data-informed approach to surveillance. This involves understanding the specific business activities of the firm, identifying potential regulatory risks under OSC purview, and selecting appropriate internal and external data sources to monitor those risks. Regular review and modification of surveillance systems are crucial to ensure their continued effectiveness and compliance with evolving regulatory expectations. A proactive stance, grounded in a thorough understanding of the regulatory framework and a commitment to data integrity and privacy, is paramount. Question: Compliance review shows that a registered firm operating in Ontario, Canada, is developing its internal surveillance program. Which of the following approaches best aligns with the Ontario Securities Commission's expectations for effective internal and external data utilization for surveillance purposes? Options: A. Develop a risk-based surveillance framework that integrates relevant internal data, e.g., trading activity communications, with carefully selected external data, e.g., market news, regulatory announcements, and is regularly reviewed and updated based on identified risks and regulatory changes. B. Focus exclusively on collecting and analyzing all available internal trading data, assuming that any misconduct will be evident solely from the firm's own transaction records. C. Implement a broad data collection strategy that gathers every piece of internal and external data possible, without a specific risk assessment, to ensure no potential violation is missed, regardless of data relevance or privacy implications. D. Establish a fixed surveillance system based on initial risk assessments and maintain it without modifications, unless a significant regulatory breach is explicitly identified by external parties. Question 19. Analysis of trading data for potential market abuse in Ontario, Canada, presents a significant challenge for compliance departments. A firm's compliance officer is reviewing the firm's surveillance program. Which of the following approaches best captures and analyzes market and trading information for surveillance purposes, aligning with OSC expectations? Option A. Conducting a cursory review of a small sample of trading alerts generated by the surveillance system, with a focus on high-volume trades, and documenting findings only when significant misconduct is immediately apparent. Option B. Primarily relying on investor complaints and tips from external sources to initiate investigations into suspicious trading activities, with minimal proactive data analysis. Option C, limiting the scope of surveillance to only the most liquid and actively traded securities, assuming that less actively traded instruments pose a negligible risk of market abuse. Option D, implementing a multi-layered surveillance system that utilizes automated tools to flag anomalous trading patterns, followed by a documented, in-depth investigation of each flagged alert by trained personnel to determine the nature and potential regulatory implications of the activity. The correct answer is D, implementing a multi-layered surveillance system that utilizes automated tools to flag anomalous trading patterns, followed by a documented, in-depth investigation of each flagged alert by trained personnel to determine the nature and potential regulatory implications of the activity. Explanation: analysis of market and trading information for surveillance purposes is a critical function for compliance officers in Ontario, Canada, particularly under the Ontario Securities Commission (OSC) regulations. The challenge lies in effectively identifying potential market manipulation, insider trading, or other illicit activities from vast datasets, while ensuring the surveillance process is robust, efficient, and legally defensible. This requires a deep understanding of trading patterns, market dynamics, and the specific rules governing securities markets in Ontario. The best approach involves a proactive and systematic methodology that leverages technology and human expertise. This includes establishing clear surveillance parameters based on regulatory expectations and business risk assessments, utilizing sophisticated surveillance software to flag anomalies, and then conducting thorough, documented investigations into these flagged activities. The focus is on identifying deviations from normal trading behavior that could indicate misconduct. This aligns with the OSC's mandate to protect investors and maintain fair and efficient capital markets by ensuring firms have effective systems in place to monitor trading activity. The systematic capture and analysis of data, coupled with a structured investigation process, provides the necessary evidence for regulatory reporting and internal action. An incorrect approach would be to rely solely on reactive measures, such as investigating only when a specific complaint is received. This fails to meet the proactive surveillance obligations mandated by the OSC, which expects firms to have systems in place to detect potential misconduct before it escalates or causes significant harm. It also risks missing a wide range of manipulative or illegal trading activities that may not trigger a formal complaint. Another incorrect approach is to conduct superficial reviews of flagged alerts without proper documentation or follow-up. This undermines the integrity of the surveillance program. If flagged trades are not investigated thoroughly, the firm is not fulfilling its duty to monitor and report suspicious activity, potentially leading to regulatory sanctions for inadequate surveillance systems. The lack of detailed investigation and documentation also makes it impossible to demonstrate compliance if the OSC requests evidence of surveillance activities. A further incorrect approach is to focus surveillance efforts only on high-profile securities or known problematic traders, neglecting broader market activity. While focusing on high-risk areas is important, a comprehensive surveillance program must encompass a wider range of trading to effectively identify emerging patterns of misconduct or manipulation across different market segments. This narrow focus could allow illicit activities in less scrutinized areas to go undetected. Professionals should adopt a decision-making framework that prioritizes a risk-based, technology-enabled, and thoroughly documented surveillance process. This involves understanding the specific regulatory requirements of the OSC, identifying potential risks within the firm's trading activities, implementing appropriate surveillance tools and procedures, and maintaining a clear audit trail of all surveillance activities and investigations. Regular review and enhancement of the surveillance program based on evolving market practices and regulatory guidance are also crucial. Question 20. The review process indicates that on a particular trading day in New York, a publicly traded company executed a repurchase of its own common stock. The company purchased a total of 150,000 shares through two separate brokerage firms. The weighted average price paid for these shares across all purchases on that day was $50.25. At the time of these purchases, the highest bid for the security on the consolidated tape was $50.10, and the last reported transaction price was $50.15. The average daily trading volume (ADTV) for this security over the preceding 4 calendar weeks was 500,000 shares. Based on these figures, which of the following assessments most accurately reflects compliance with the safe harbor provisions of Rule 10b-18 of the Securities Exchange Act of 1934? Option A. The company complied with Rule 10b-18 as the total dollar amount spent on repurchases was within the company's authorized budget for stock buybacks. Option B. The company violated the price condition of Rule 10b-18 because the weighted average purchase price exceeded the last transaction price, but complied with the volume condition as the purchases were made through two brokers, which is permissible. Option C. The company violated the price and volume conditions of Rule 10b-18 because the weighted average purchase price exceeded the highest bid and last transaction price, and the total volume repurchased exceeded 25% of the ADTV without the purchases being made through a single broker. Option D. The company complied with Rule 10b-18 because the total volume of shares repurchased, 150,000, was less than the ADTV of 500,000 shares, and the average price paid was only slightly above the last transaction price. The correct answer is C. The company violated the price and volume conditions of Rule 10b-18 because the weighted average purchase price exceeded the highest bid and last transaction price, and the total volume repurchased exceeded 25% of the ADTV without the purchases being made through a single broker. Explanation. The review process indicates a potential violation of Rule 10b-18 under the Securities Exchange Act of 1934, specifically concerning the timing and pricing of a company's stock repurchases. This scenario is professionally challenging because it requires a precise understanding of the safe harbor provisions of Rule 10b-18, which are designed to protect issuers from liability for market manipulation when repurchasing their own securities. The complexity arises from the interplay of various conditions, including timing, price, volume, and the role of a designated dealer. Compliance officer must meticulously analyze the transaction data against these requirements to determine if the safe harbor was maintained. The best approach involves a thorough calculation of the average price paid for the shares repurchased on the day in question, and comparing it against the highest bid or last transaction price, as well as ensuring the volume of repurchases did not exceed the daily limit. Specifically, the compliance officer should calculate the weighted average price of all shares purchased by the issuer on that trading day. This weighted average price must not exceed the highest bid or the last transaction price on the consolidated tape at the time of purchase. Furthermore, the total volume of shares repurchased by the issuer on that day must not exceed 25% of the average daily trading volume, ADTV, for that security, unless the purchases are made through a single broker or dealer. In this case, the company purchased 150,000 shares at an average price of $50.25. The highest bid on the consolidated tape at the time of purchase was $50.10, and the last transaction price was $50.15. The ADTV for the security was 500,000 shares. The company used two brokers for its purchases. This approach is correct because it directly addresses the price and volume conditions of Rule 10b-18. The weighted average price of $50.25 clearly exceeds both the highest bid $50.10 and the last transaction price $50.15, violating the price condition. Additionally, the total volume of 150,000 shares exceeds 25% of the ADTV 25*500,000 equals 125,000 shares. And since the purchases were made through two brokers, the exception for a single broker does not apply, thus violating the volume condition. Adhering to these specific price and volume limitations is paramount for maintaining the safe harbor under Rule 10b-18. An incorrect approach would be to solely focus on the total dollar amount spent on repurchases without considering the price limitations. For instance, if the focus was only on the fact that the total expenditure was within the company's authorized repurchase budget, this would be a regulatory failure. Rule 10b-18 safe harbor is not contingent on the overall budget, but on adherence to specific pricing and volume parameters during the trading day. Another incorrect approach would be to overlook the fact that the purchases were executed through two brokers when assessing the volume limitation. Rule 10b-18 provides a safe harbor for repurchases up to 25% of AdTV, but this limit is subject to the condition that purchases are made through a single broker or dealer. If multiple brokers are used, the 25% AdTV limit still applies to the total volume, and the safe harbor is jeopardized if this limit is exceeded. Ignoring this distinction would be a significant regulatory misinterpretation. The professional decision-making process for similar situations should involve a systematic, data-driven review of all repurchase transactions against the specific requirements of Rule 10b-18. This includes 1. Verifying the identity of the broker. Use 2. Calculating the weighted average price paid for all shares purchased on the relevant day and comparing it to the highest bid and last transaction price. 3. Calculating the total volume of shares repurchased and comparing it to 25% of the AdTV. And 4. Confirming that all other conditions of the rule e.g. no purchases during certain periods, no manipulative practices, were met. Any deviation from these conditions necessitates further investigation and potential disclosure.